Imagine waking up one morning to the shocking news that the United States has officially announced it will no longer pay its debts. A decision like this, made by the world's largest economy, would send shockwaves through global financial markets. Soon after, major economic powers such as Germany, the United Kingdom, Japan, and France begin to follow suit, stating their own intentions to stop paying their national debts. The news spreads rapidly, and a sense of panic begins to take hold. Stock markets plunge, the value of currencies collapses, and international trade begins to slow down. Investors lose confidence in the ability of these nations to meet their financial obligations, and the world's economy starts to unravel. The question now arises: what happens when the world's most powerful countries decide to stop paying their debts? This scenario could have far-reaching consequences, not just for these countries, but for the entire world. Today, we will explore the implications of such a global financial crisis and how countries could navigate through this catastrophe. The role of national debt. National debt has long been considered an essential tool for modern economies. Governments borrow money to fund infrastructure, defense, social programs, and other projects that benefit the public. But what happens when the debt grows too large to manage? In the case of the United States, the country's national debt has reached an alarming size, standing as the largest debt in the world. Despite this, the U.S. continues to borrow more and more money, adding trillions of dollars in debt each year. While this debt allows the U.S. government to finance its operations, the question remains: how sustainable is this system in the long run? Countries like Japan, for example, have national debts exceeding 250% of their GDP, and yet Japan remains relatively stable. Still, even the most powerful and wealthy nations face consequences when their debt becomes unmanageable. If these countries were to stop paying their debts, it could send the world's financial system into a tailspin. The consequences of defaulting on debt. If these nations were to suddenly stop paying their debts, the immediate consequences would be devastating. First and foremost, the global financial markets would be thrown into turmoil. The world would witness one of the most significant financial crashes in history. Investors would begin pulling out their money from international markets, leading to massive sell-offs. Stock prices would plummet, and banks that hold government bonds, such as the U.S. Treasury bonds, would suffer catastrophic losses. Countries that rely on U.S. debt as a safe investment would lose billions of dollars. Furthermore, the dollar could lose its status as the world's reserve currency, creating uncertainty in international trade. The global economy could be thrown into a deep recession as inflation skyrockets, causing prices for everyday goods to soar. Businesses would shut down, unemployment would rise, and entire industries could collapse. How countries can avoid default. So, what can countries do to avoid defaulting on their debt? There are several possible options, but none of them come without risks. One potential solution is debt restructuring. In this scenario, countries negotiate with creditors to extend repayment periods or reduce interest rates. This process allows nations to breathe easier, but it can take time and requires the approval of all parties involved. Another tactic used by many countries is inflation. By allowing inflation to rise, governments can effectively reduce the real value of their debt. While this can make debt more manageable, it also comes with serious risks, such as weakening the currency and eroding the purchasing power of citizens. Countries might also choose to devalue their currency in a controlled manner to help manage debt, but this could lead to further instability and loss of investor confidence. The power of debt in global finance. Debt, while often seen as a burden, can also be a powerful tool. Countries like the United States, Japan, and Germany use their enormous national debts to exert influence over the global economy. By controlling such vast amounts of debt, these nations are able to shape international markets, trade agreements, and even geopolitical decisions. The global financial system depends heavily on the willingness of these countries to maintain their debt obligations. If too many countries were to default on their debt, the entire system could come crashing down. This could shift the global balance of power, ushering in a new era of financial instability. As we can see, the ability to control debt is not just a matter of economics, it's a matter of global influence and power. Nations that hold the world's debt wield immense leverage on the global stage. National debt is a complex and powerful force that can shape economies, influence global markets, and even determine the political landscape of nations. As we've seen, the consequences of a nation defaulting on its debt could be catastrophic, not only for that country, but for the entire world. However, debt is also a tool that can be used to maintain global dominance or to help a country survive during tough times. How countries handle their debt will be one of the most significant challenges of the 21st century. As the world continues to face economic uncertainty, understanding the implications of national debt has never been more important. If you found this video insightful, don't forget to like, subscribe, and share it with others who may be interested in understanding the global financial system. Also, leave your thoughts in the comments below. What do you think would happen if the world's most powerful countries stopped paying their debts? How would you handle the global crisis? Let's discuss.